It's Money Monday. While the Federal Reserve decided not to increase interest rates last week, mortgage rates are still near a 22-year high. As of last week, the average 30-year fixed mortgage rate has been above 7% for 5 straight weeks now. Demand is also some of the lowest it's been in recent years. Joining us today is Paul Hood with Hood CPAs. Paul, thanks for being here.
Hey, thanks for having me.
We've talked about this before, but it affects a lot of people.
It does.
First off, just what causes the mortgage rates to be this high?
Well, you know, it's the Fed rate. Everything is based on the Fed rate, which determines the cost of money. And so everybody follows suit on that. When the Fed raises rates, then I don't care if it's automobiles or houses or credit card, they all raise. And it's just part of their monetary policy to try to slow down the economy, slow down inflation. You know,
I've talked to some realtors too, and they say that supply is extremely low. Why is the supply so low?
Well, I mean, it's just like anything else. If the price of cars are real high, people don't go trade their car in. They keep their existing car. So people are not upgrading like they did a year or two ago when interest rates were really low. You could go, you know, parallel and get a bigger house and have a reasonable interest rate. But right now, you got a lot of people that are locked into 2, 3, 4% interest rates. And if they go and try to buy another house, they can get about, for the same payment, half the house because the interest rate is double.
You know, you mentioned the 2% rate. Obviously, people don't want to move. Obviously, life happens, though. People have to move. They have to buy. So what does this mean for the average family right now?
Well, what we're encouraging people to do is potentially rent, you know, for a period. Mm-hmm. You know, the interest rates are going up and down. We don't know what's going to happen politically over the next year, year and a half. We don't know what's going to happen economically. It's just they're spending so much money. They've got these interest rates very, very high. And the fact that the government is spending a ton of money actually works in our favor as far as interest rates. Because if interest rates are higher, they're paying more interest on their bonds. So, you know, it's a good time to hold. Look for good deals, you know, but it's just like you go buy a car and they say you can get 2% financing. You're not getting 2% financing. They're lowering the cost of the vehicle because they need to sell it. So look for opportunities, but it's an okay time just to kind of hold. But if you're forced to move and you're moving to another city because of a job, you know, it's probably a good idea to rent for a period, maybe 6 months, a year or 2 years, and see what happens. If you do need to buy and you decide to buy and you find that house, maybe consider doing a variable, you know, rate to where, you know, every 5 years it'll adjust. Where if you lock in, the opposite is true for what people have now. If you've locked into a 2.5%, 3%, 4%, 30-year fixed rate, you're in great shape unless you need to move. But if you lock into a 30-year rate at 7, 7.5%, 8%, that's not a good deal.
Yeah, well, you know, and I know a lot of mortgage companies are working with people too, and they are encouraging that, and they're willing to get rid of some fees and things too.
Yeah, well, and there's a ripple effect in the economy. There's builders, it affects realtors, their commissions, it affects mortgage brokers. It really has a negative effect depending on how you look at it.
All right, Paul, thanks for being here. Good advice.
Thank you for having me.
Appreciate it.